Good morning, ladies and gentlemen. Nothing much to see here in the risk on, risk off dials. We're still in risk off, and I think we are likely to remain in risk off, even if we have a pretty sizable retracement in asset prices over the days and weeks ahead. That's because of what Powell has told us. And let's have a look at actually what the FOMC wrote down in their summary of economic projections and how that is likely to affect the asset prices in the weeks ahead. Powell was extremely candid. He basically said that they have no more clue than anyone else, and what they wrote down was something that they had to write down because it's their job to write it down, but their confidence in achieving these numbers is extremely low. So what did they do? They reduced the GDP, the real GDP forecast, and they increased the core and PCE inflation quite substantially. But they're still looking for real growth. And if you add the PCE inflation or even the core inflation to the real number, you get a nominal number of around 4.4% GDP growth in 2025. That, to me, is the least likely outcome. Either GDP growth will go back to where it was, or it will collapse. A nominal GDP growth of 4.4% to me is just unlikely. Either we're going to have a recession or we're not. Now, could it be 4.4%? Yeah, it could, but so many things would have to, sort of superimpose on each other for it to be there that I think it's the least likely outcome. The more likely outcome is either we have a recession, in which case this goes towards zero, or we don't have a recession and all the other measures, the reflationary measures, and by that I don't mean that they increase inflation, but that they increase productivity and GDP growth, like deregulation, etc., take over, and the US economy does great with low inflation, i.e. productivity takes off. There are absolutely, the regulation gets thrown out of the window. You get a boom in energy, in the energy industry, you get a boom in banking, people borrow again, and therefore we go from what they want to achieve, which is a redistribution of the going from the public purse to the private purse, and you get a proper investment-led boom from the private sector. One of those two is far more likely to happen than this. So to me, this is extremely low odds, and to them, it's extremely low odds. They have very, very little confidence, if any, in these numbers. So what does that mean to us? It means that they are more data dependent than ever. If we look at the distribution of their dot plots, you can see what I mean. No one is going for hikes in 2025. This is 2025. Either they're going for unchanged policy or one or two cuts, or a couple of them, and we know who those are going for 3 cuts. But if you get recession, they will be down here, okay? They will take policy down here. And if you don't, at best, everyone is going to be here, i.e. no cuts at all. So to me, the base cases are either no cuts or 200 basis points of cuts, and very quickly, because if we go into recession, they are going to cut this very aggressively, probably over the course of 3 or 4 meetings, and it will be very fast. It will end sometime in September, October. It won't continue. It's not going to be a 25, pause, 25, because that is not the way they cut during recessions. Either we're going to be down here or we are going to be up here. I think all these people here are on pot. And I just wanted you to be aware of what real rates do during recessions. This is the mistake they made. They didn't bring them down fast enough, or they couldn't bring them down fast enough. And we know that during the GFC, there were a lot of problems of bringing rates, real rates down. They finally managed it, and over time, rates went down towards zero. Had they come down to zero faster, it would have been a smaller crisis. And here we have the COVID crisis, where they actually managed to get rates down into negative real rates. And that is what they would have to do, get real rates down towards zero in case of a recession. So the odds of real rates remaining here are very, very low. Either they come down towards zero in a recession, or the likelihood is that we go back up towards 280 to 3%. If growth picks up again and they can't cut the budget deficit fast enough, I think the real rates are going to keep on rising. I don't see any reason why they shouldn't. I know Besant wants to get them down. I want a lot of things in life, and I'm not going to get them. So it's unlikely to me that we stay at this level. Either bonds are going to have a major rally and real rates are going to go down, below 1%, or we're going to go and test these kinds of levels, 268 to 75 at some stage this year. This is term premium, so for all the people who say, well, Nick, but if there is a recession, you will get much, much lower rates at the long end, that is not necessarily true, because as you can see, and these great periods are recessions, term premium actually tends to be constant or even rise in recessions. And that is because what happens, the yield curve steepens like crazy. So it's unlikely that the rally is going to be in tens. The rally is going to be in twos and fives. None of this, of course, is going to happen anytime soon. I just want you to be aware that we are in a disequilibrium situation, because what we are going through at the moment is fear of a recession, i.e. a growth scare. Well, growth scares either come about or they don't, and the data confirms it. So everything I've been saying for the past couple of months is actually where we are. We are in a growth scare. We don't know whether it's going to be realized. In either case, we're in a disequilibrium position. We either go to a much lower equilibrium if we do get a recession, and I think that the Fed is acknowledging that by telling you that their policy uncertainty is at a maximum, i.e. they wrote down those dot plots because they had to write something down. They have about as much clue as what the effects of a trade war and or other policy implementation by the current administration are going to be as we do. They are going to be maximally reliant on data going forward. And that is why the market, I think, is going to do very little in periods before the data comes out and a hell of a lot on the data. So having said all that in the preamble, of course it's going to be absolutely useless for next week, because nothing that I've told you so far is of any use in the short term until data strikes. I just wanted you to be aware of the background, how I'm thinking about markets, and that I'm not thinking about what is going to happen next week. I'm thinking about what is going to likely happen in May, June time of this year. Okay, so what is going to happen next week? The ranges in the bond market have been more or less exactly to the tick what I thought they would be. And I think there is no reason to expect next week for the bond market to go outside of these ranges. Every time you get to 405 or 410, there are buyers in twos. We're still below general collateral. I still am not going to buy twos or fives because I just don't see any reason to lose money on the funding while I'm waiting for data to tell me. Once the data tells me, I'll be perfectly happy to lose money on funding because I know that I have something to look forward to. I have a target. And if my target is going to be down here, I don't mind losing a little bit on a day-to-day on a 2 or a 5-year piece of paper. That to me makes no difference. It'll make like 3-4 basis points difference over the course of a month. Why should I worry about that, right? So if I'm looking to make 30 basis points and I lose 3 basis points on the funding, I still make 27. So that is not my bother. Now I see absolutely no reason why I should lose money on the funding, and therefore I'm not going to buy twos or fives. To me, it's nowhere, right? Whether you make 3 basis points in a week or lose 3 basis points in a week on the fives, before the important data strikes, I'm just not going to play with them. So what can you look at? You can look at the 10s and you look at the 30s where you're not losing money on the funding. Next week we have 2s, 5s and 7s, so I think all the pressure is going to be on the 2s, 5s and 7s, which are way below collateral. And it's unlikely that they're going to be able to rally at all. And if anything, the yield curve should flatten a little bit. 10s, I think every time they get to 235, they're going to be buyers because there's absolutely no reason not to buy there at general collateral. And every time they get to 415, they're going to be sellers. We are absolutely stuck. And I really wouldn't have thought that 10s and 30s are going to move very much at all. Last week, the yield curve did steepen a tiny bit. If you look at what happened, actually, it's 1, 2, 3, 4, 5. It closed absolutely unchanged, although it did try to flatten a little bit. It couldn't do it over the course of the week. To me, they should try that again. And, this is the kind of level that I would like to look for a steepening, i.e. minus 20. But until I get levels that I want to trade, I will leave these alone. What is obvious is that people like the 5s, 30s. Why? Because the 5s have some duration and therefore they can make some money on being long 5s. And the 30s they're unsure of, and therefore they're leaving them alone. To me, do I want to be long 530s at these levels? I don't know. I'm not all that enamored with 5s where they are. I'd much prefer to be long of corporates in the 5-year area than in US Treasuries, because at least you get a bit of a spread. Here, I just don't know. I'm not going to play against them, but given that the auctions are next week of 5s and 7s, 2s, 5s and 7s, and the fact that we are so far down, and let's have a look, you can see how long markets hesitate in this area here, that I can see very little upside in being long of 5s, 30s and looking for something like minus 67. It's going to take a lot of time before the 5s, 30s break minus 67, I believe. And I'm just not willing to play until I see the white of their eyes, until I see a reason to really steepen the curve in the 5s, 30s area. I don't see it at the moment, just like I told you earlier. I think waiting for data and just collecting theta, is probably best until you see really important data. How do you collect theta? Well, you just say 10s are unlikely to go much above 438. You work out what the strike there is, and you collect theta on a 1 week put in the futures. That is what you do. It just seems very, very silly at the moment to have large positions, because what are you expecting in the next week? Nothing much, and therefore why position at all? Periods like this happen, and they're normal in trading, that you have periods in which making 1 or 2 basis points is all you can hope for. This is one of those periods, but then they're followed by easier moves which go 20, 30 basis points. And don't be rash. There's no reason for it at the moment. Just wait for the data to tell you, because when the data does tell you, these markets are going to move a long way. So in Germany, what are you getting? You're getting twos doing absolutely nothing and returning to exactly where they were before the shock announcement. That has been confirmed. And, they belong here. Nothing should have happened to the twos. They just moved in sympathy. Fives, they're returning to probably something around 233. And tens, they're returning to probably something around 265 to 270. Where would I like to get short of bunds again? I would love this kind of area. 265 to 268 area is where I want to go short of bunds again. What is the yield curve doing there? 2s10s actually has stopped the steepening, but the 5s30s are continuing their steepening, just like in the US. The sweet spot seems to be somewhere around 5s. People like to have a bit of duration on board, both in Germany and in the US, but they hate the very long end because they know that in Germany especially, you are going to get some continued steepening because of what they're doing in terms of the debt brake. What to do? Really, you want to wait until the German 10-year Bund is at a tradable level, which is going to be around 265, and then you want to buy long-term puts in the futures. And you really want to wait until the yield of the Bund and the yield of the US 10-year are at an important level against each other. And let's have a look at that. So here we have the 10-year spread between Germany and the US. I think I'm right in thinking that we are going to fill this gap kind of thing, probably not all the way, but something to the 162, 163 level. So what am I looking for? I'm looking for the Bund to be at least in the 260s and the spread to be around this kind of 152 to 162 area. Once both these conditions are met, I think it's time to go short of the very long end of Germany. Whether you do it via steepeners or whether you do it outright or whether you do it on a spread against US, I think it probably doesn't really matter, or we do it a combination of all three. But I think that at worst, bunds are going to do nothing from those yield levels, and at best, they're going to have big moves over the course of the next few months. As I showed you some weeks ago, the monthly charts are very, very important. In fact, we can actually look at those again. German yield curve, DE10, and let's go for 1 month. We stopped exactly where we should have. We are now going to probably consolidate for a month or so around these levels, close, and then over time be able to go higher. To me, the real yields in Germany are just not going to be high enough, unless we get a recession, of course, are just not going to be high enough to support the extra borrowing or the massive extra borrowing they're going to have to do, because this is just stage one of what they're going to have to do. If they want to build an army, it costs a lot of money, and rates go higher. I think it's terribly, terribly unlikely that German yields go down below 250 at any stage over the course of the next 2 or 3 months. So anywhere around, as I said, the 260s, I think all the pressure on the spread is going to be higher. So even if there is a recession, the recession comes in the States, so you want to have some of everything. You want to have some steepener, you want to have some outright, and you want to have some on a spread against the US. I was asked to have a quick look at gilts ahead of the spring statement next week, and it's a really, really difficult market. This is the gilt, the 10-year gilt outright, and as you can see, just cannot get away from the high yields that we experienced 2 years ago. Everything else seems to have been a correction since then, and we keep on coming back to this 475 level and looking to break it really and go up towards into the fives. Now that seems unlikely at the moment, simply because I don't expect the bunds to go yet. I don't expect the tens to go yet. Therefore, if I expect the gilts to go, I'm really looking for the spread to go. So let's have a look at the spread against Germany. And yeah, it could easily come back to this 205, 210 area where it came from on the announcement. It all depends on what the spring statement is, I guess. If they're going to increase borrowing there as well, probably no reason why this spread should really change very much. So this is another 15 basis points. So you could get a 15 basis points outright move in the gilt. Let's say that the bund does nothing and the gilts go up. If you have a look at it against the US, it's certainly, the possibility is that it's starting a new leg and that we could go all the way to 68. So that is another, let's call it 20 basis points. So what it's saying is that there's a decent possibility that gilts go another 20 basis points in against the US, and something similar, but probably something a little bit smaller against the bund. So that's 15 against the bund and 20 against the US, if it's a bad statement and we go to these levels. But I really would have thought that that kind of level, unless it's a tragedy of a statement, will hold it for the time being. I just don't think that the gilt is going to go all by itself and keep on going. It all naturally depends on what the statement is, but I just can't see that the UK is going to diverge in its policies so much against its neighbours. So just like I don't think it's time yet for the spreads between bunds and the US to diverge, but yes, I think they're probably going to come in slightly. I think the dollar is going to retrace towards this 105 level, and it's going to have great difficulty going through it. 104 anything, 104.50, 104.80, and you're looking to sell dollars. I think it's far more likely to test eventually in the next few weeks around this 102.80 area than go through this 105 area. Euro yen keeps on failing at 164, and that is really what I expect. And the interesting thing about that is the yen is slowly turning the 200-day moving average. What does that tell me? That tells me that in the short term, the yen is unlikely to go above 151. It might try to go to 150, stop all these people out, go up to 151, but that's about as far as it can go. And then I think it's going to have a move down. That actually has implications for asset prices, for equities, which is basically saying that you are not going to get a risk off anytime soon, that you are more likely to get a bit of a risk on for the next few days before the risk off comes. It's terribly, terribly unlikely that equities make a profound move to the downside while the yen is really testing the upper bounds around this 151.60 area. So I think I want to wait for 151.60, and only after that it's tested and failed do I want to start shorting equities. Gold is still doing nothing wrong. Only once it breaks 29.50 will it have done something wrong. In the meantime, it's just trading around, and even on spreads, it doesn't look bad. Even if you look at something like gold against EBIT, which is the Bitcoin ETF, it's not doing anything wrong. Gold against BTC, of course, the same kind of thing. I think it's just trading around at the moment. And if you have a look at gold against TIP, it's still in a very strong uptrend, which I don't understand. Gold over STIP, still in an uptrend. Gold over TLT, still in an uptrend. And gold over SPY, maybe it's overdone. Maybe it can come back some. This kind of pattern here tells me that they keep on trying the upside and failing here. And that probably tells me that gold is going to go sideways to possibly down, while equities do slightly better and we get something like a 48 level over the course of the next week or so. So I would at the moment prefer equities to gold, but not a lot in it. It's a trade as opposed to a position. GSG, absolutely nothing going on. It's still below this 22.93, which I think is absolutely crucial. Until it goes through there, I don't think you want to do anything in equities. And it's telling you that the price of oil is going to be stable. It's telling you that nothing much is happening in the inflation space, and not to look for anything and not to trade it until it starts breaking. I still think that the break is going to come eventually to the upside, but it's nowhere near at the moment. And if we have a look at SPY over GSG, it tells you that there is a little bit of possibility that SPY rallies and say back up to this kind of level. SPY over GSG, if you say that GSG does nothing, then there's 3-4% move in equities over GSG, and that is probably what I favor. I favor a move up in equities over the course of the next week or so. It's not going to be huge, but probably worth trading. So last week we tried to go down in SPX, we tried to go up, failed at both, and basically we're closed, within 0.25% of where we closed the week before. As I keep on telling you, we are still below the weekly Bollinger Bands, and that doesn't last forever. So I am actually looking for a bit of a move up. We closed exactly at my level, the 56.69, 56.70, whatever you like to call it. And really that is to me a recipe for uncertainty and continued trading and gap filling. As you can see here, the Bollinger Bands are coming down and they're going to provide resistance, which to me says that it's going to be a very difficult upward path for equities, but that they're more likely to try and break upwards than downwards. Now we have gaps all over the place. We have a gap all the way down to 55.21, and we have the first gap up here to the close of 57.69, and then another gap up here to 58.44. I think this gap up here is going to be very difficult to close over the course of the next couple of weeks. But next week, I would have thought that the odds of us closing this gap to 57.70 are better than not. I think this gap down here is not going to get closed anytime soon, simply because I don't think that there's enough reason, or that the weeklies allow that to happen. If it were to happen, I think it's a great buy. I mean, buy calls spreads, because it's going back. This 56.69 area is a great area for 50 points up or down. And I think the first 50 points, at least 50 points, are up. And then we try to close this gap by the end of the week. And that's probably all she wrote. It's pretty impressive how well NDX is trading technically. This 19,900 level is absolutely capping it. And as you can see, the Bollinger Bands are coming in. Just wanted to show you a longer term chart. And if we now enlarge into it, we can actually see exactly what is going on and where the gaps are. Just like in SPX, the first gap is here to 20,200, and then the gap is actually here to 20,600. The one that I said in SPX is unlikely to get filled anytime soon, and I do believe that. I think next week, if we don't fill this gap all the way down to 19,224, which I don't think we can, we are more likely to start breaking up and filling this gap. Filling all the way up to that gap is unlikely to me, because I don't think we've got enough time next week. But I certainly think that this gap can get filled to 20,200, and that's 500 points. And that's probably something that you can trade for, looking to buy any kind of a dip and letting it go up here. I also wanted to show you the clean chart and how difficult it's going to break here, this 57.62 area. I think it's going to be very, very difficult to break it next week, but that is just enough to start filling this first gap. So to me, any longs you have, 57.62 SPX is where you want to be out of it. And I also wanted to show you vol, and I think vol is telling the entire story. It came back and closed well below both 2060 and 2279, which tells me that it might try all the way down to 1725. If you see 1725, which should correspond with that higher level in SPX and NQ, you want to load up the boat again, because I think it's going to do another at least 300, 400 higher after that point. So everything is really matching. You get a yen, dollar yen, which tests that 150, 160 area. A little bit of risk on, a little bit of volatility coming down as people overwrite with calls their positions, and then that it should be everything that the stock market can do to the upside. The foreign markets, including EEM, are telling you exactly the same story. Look at how they are unable to stay above 45.04. These are the weekly Bollinger Bands. We're right on top of them. You know, a few weeks of going sideways here, and that would allow the Bollinger Bands to open and these moving averages to turn, is probably what is needed at the moment. But you can see how EM since the beginning of the year is up while the US is down. And I think that will correct at this very moment. But that trend should continue later on in the year. So if I think that this is correcting and coming back down towards 43, and while the SPX does actually a little bit better, then I have to start thinking that it's going to be just a correction in SPX upwards rather than the start of a trend. So that is all I've really got for you. I think that the spread between EM and SPX corrects slightly, and that enables SPX to do a little bit better. We have a little bit of risk on, we have a little bit of weakness in the yen itself, which caps around that 150, 150 area. And then you start getting some risk off again, which tells me what? That the data that comes towards the middle to end of next month is going to be far more important than anything that we're going to get next week. And next week is unlikely to be any kind of confirmation of anything that the Fed can look at or would look at. And when you don't have data, you have markets which are technical and correcting. In conclusion, I think it's going to be a little bit of a risk-on week. I think the equity markets can probably do a little bit better, but they will fail at either 57.62 or 58.40. I think 58.40 is unlikely. I think it fails at 57.62. I don't think bonds are going to do very much at all because the data is not going to allow them. There's going to be early pressure in the week on 2s, 5s and 7s, and therefore I think the yield curve is likely to flatten a tiny bit. I still don't like bonds. I still think that eventually they will go down, but it's going to take a long time. So look for 265 at the first level that you can short them, and short them on a spread, probably against the US. You want to wait for this, let's say 160, 162, and that should be the trend for things of next week. Thank you very much indeed, and tweet you on Monday.